Imagine waking up tomorrow and discovering that a tiny piece of thousands of businesses around the world is for sale. Not their products, not their buildings, not their employees, the businesses themselves. This is essentially what the stock market is. Most people think the stock market is a giant casino where prices randomly go up and down. But reality is much stranger. A stock is simply a small ownership stake in a company. When you buy one share of a company, you become a partial owner of that business. If the company grows, becomes more profitable, and investors believe its future looks promising, the value of that ownership usually rises. But here's where things become interesting. The stock market is not really a place where companies and investors constantly trade with each other. Most trading happens between investors themselves. Imagine someone bought shares of a company years ago. Today, they decide to sell. Another investor decides to buy. The company doesn't receive that money. The ownership simply changes hands. This happens millions of times every day. In fact, on major exchanges like the New York Stock Exchange and NASDAQ, billions of dollars worth of shares are traded daily. But if stocks represent ownership, why do prices move so much? Because stock prices are driven by expectations. Not what a company earned yesterday, but what investors believe it will earn tomorrow. If a company reports record profits but investors expected even more, the stock can fall. If a company loses money but investors believe better times are coming, the stock can rise. The market is constantly trying to predict the future, and that's why prices can change every second. But this creates a surprising paradox. In the short term, emotions often dominate. Fear, greed, excitement, panic. During the 2008 financial crisis, global stock markets lost trillions of dollars in value as investors rushed to sell. Yet many of the underlying businesses continued operating. Factories still produced goods. Employees still went to work. Customers still bought products. The perception of future value changed faster than reality itself. And that's the secret most people never fully understand. The stock market is not a measurement of what companies are. It's a measurement of what millions of people collectively believe companies will become. Every trade is a prediction, every price is an opinion, and every market crash or boom is ultimately a reflection of human expectations about the future. Thanks for watching. If you enjoyed it, subscribe for more. See you in the next video.